Hey guys, Toby Mathis here, and today we're going to go over how rich people avoid paying taxes. In fact, we're going to go over 11 strategies. So number one, and this is one that you see full videos dedicated on, including by yours truly, and it is using the buy, borrow, die strategy. And what this is the rich have figured out that when you borrow against an asset, it's not taxable. So what type of assets are we talking about? A lot of people think immediately real estate, and that's true. Like you can borrow from your house, you can borrow from your rental properties. You don't have to pay tax on that. But we're also talking about things like whole life insurance, IULs, things like that, where you can borrow against the cash value. Or if you have a retirement plan that allows lending, you could borrow against that. You could lever these assets. You could even borrow against your house and go buy another investment asset and then borrow against that and buy another property, right? You can use these things as a little chain, but what's really important to know that depending on the type of asset it is, you may never pay tax on it at all. You may continue to grow. In fact, one of our number here, one of our strategies is going to be how you don't pay tax on real estate. You could use that in conjunction, and then when you pass away, the basis steps up on a lot of these items. So for example, if I have a bunch of stock and I've borrowed against it using a security-backed line of credit, which you can do tax-free, and then that stock goes up, and then when I pass away, my family could sell it, but they don't have to pay tax on any of that gain because it's stepped up in basis. Same with real estate. All capital assets are like that. Or perhaps I borrow against my life insurance policy. Life insurance proceeds generally not taxable. So when it goes to pay it back, never pay tax on it. Again, the rich know this and they use it effectively. Number two, depreciation. And I'm going to put it into a few contexts. Depreciation just means a deduction, which means I might be able to use that deduction to offset other income I have. And I'll use a couple of examples. For example, if I have oil and gas, I might use some of the expenses that are incurred, working interest, and I have intangible drilling costs. I might be able to use that to offset against my active, ordinary other income, so my W-2 wages. Or if I'm using the short-term rental loophole, I might be able to depreciate the real estate I purchased, if you know what cost seg is, in bonus depreciation. It's just a fancy way of saying writing things off fast and at a greater amount earlier than later. I might be able to use that depreciation to not have to pay tax on a number of different things, like my W-2 income, my other business income. Maybe I'm selling other assets and I'm able to use depreciation from a new real estate acquisition to avoid having to pay capital gain on the sale. Maybe you're doing syndications, you didn't realize that you could actually do this. The wealthy know that that is a very good strategy to never have to pay tax ever again. It's using depreciation. Real estate professional, short-term rental loophole, oil and gas, all those things are areas where you're like, depreciation becomes really key. Or in a regular business, let's say that I'm buying things like a pizza oven or equipment, then I can use different sections of the code to accelerate that depreciation and write it all off. In many cases, if I'm using bonus depreciation, for example, it can create a loss that then allows me to not pay tax on other income. The wealthy know this, and you should too. Number three, employing kids and family. The reason I'm going to say kids first is because depending on the type of business, let's say it's real estate, or I'm a sole proprietor or a partnership, I could literally have those kids on my payroll. I could pay them, if they're under 18, less than the standard deduction. They will pay zero tax on it, but it's a deduction to me. If I want to just, maybe they're over 18 or they're other family members, I can get them to work for my business. They actually have to work for my business. But this is where wealthy people and rich people figure it out. It's like, hey, I want to have my brothers, I want to have my family members, I want to have my kids working for me, because I could pay them and then they could do things like put it into certain types of retirement accounts that are also going to be on our list. So maybe I'm paying my kids, and if they're under 18, I know that the standard deduction, which is over $15,000 a year now, I could be paying them up to $15,000 a year, and they don't have to pay any tax on it. It's deductible to my business. That is fantastic. Or I have family members, and I actually have them working for the company, and I'm paying them, but they're putting a big chunk of that into retirement plans. Maybe they're funding HSA, maybe they're doing IRA, 401k. They're able to put money aside and reduce the taxable amount on that. Rich people know that, and you should too. Number 4, entity classifications. The wealthy know that depending on the activity that I'm engaged in, there are different ways it could be taxed. So for example, if I am making $200,000 a year as a sole proprietor, 100% of that net income is subject to something called self-employment tax. And the rich know, hey, if I make an S election, I could avoid a big chunk of that. Or if I don't want it to flow into my tax return, I could be a C Corp. Or if I know that I'm in things like real estate and I want to accelerate depreciation and offset my other income, I might need to be a partnership. Or if I don't want to have to deal with trader status and things like that, and I have a family office and I want to make sure that I'm getting deductions against certain types of my investing activity, I could use a partnership. And I could use these entities to create better tax outcomes for myself. The rich know this, and you should know that too, but they understand that that entity classification has a big impact on that bottom line. Number 5. We're going to call it HSAs and health reimbursement plans, HRPs. HSAs are really interesting because they're a triple threat. I get a deduction, which is a health savings account. And I could put, let's say I'm an individual, as long as I meet the requirements of having a high deductible plan, I could put $4,400 a year plus. So this year I could put in $4,400 a year, $4,400. I get a tax deduction for that. It grows tax-free. So if I put that into an HSA and I invest it and I quadruple it, I pay 0 in tax. And then if I take it out and I use it for health expenses, which could be dental and all sorts of things, 0 tax. It's a triple threat. The wealthy also know that if I am using like a C corporation, let's go up to our entity classification, say I have a C corp and I'm using it as a family office and I enact a health reimbursement plan, I can write off 100% of my medical, dental, vision expenses. Reimburse anything that came out of my pocket, even if I have another plan, even if I have an employer plan. If I'm paying deductibles or co-pays or things that aren't covered, I can reimburse it out of that HRP. The wealthy know it, you should too. Number 6. (1031) exchange. I could put 721 to doing an UPREIT and things like that, but a 1031 exchange is when you sell real estate and you buy replacement real estate of equal or greater value and you avoid tax on it. You could even build. There's lots of different types of exchanges, but at its core, the wealthy know that they can buy this asset class and that as long as they continue to add to their holdings, even if they sell it, they could continue to defer the tax and not pay tax. And then all they have to do is look at number 1, they can borrow against it, and then they die. And when they pass away, step up in basis, the 1031 exchange doesn't matter anymore, and they don't have any tax. So that 1031 is a way of, hey, I bought a piece of real estate for $100,000 20 years ago, it's now worth $1 million. I could sell that $1 million piece of property, and so long as I follow the rules and buy another $1 million worth of property, and it could be 2 or 3 properties, it could be 1 property, it could be a part of a property. As long as I do that, I could avoid tax on the sale, and I pay no tax on that $900,000 of gain. Pretty powerful. You should know that too. Number 7, I'm going to call it defined contribution and defined benefit plans. So I'll just leave it at defined contribution plans for now. IRAs, 401ks. These are plans where I am defining how much I can put in and avoid tax on, how much I can kick down the road. So in an IRA, for example, in 2026, you're looking at $7,500 that I can contribute and take a deduction for. If it's a 401k, then I can put money in. The employee side is $24,500. You can put up, I think it's over 70 grand now that you could put in a 401k. You could actually have multiple, so you could do a lot more than that. But I'm just saying is that the IRS defines how much you put into it as being deductible. You get a deduction going forward, but you have to pay tax when you take it out. So you will eventually pay tax. So this is a delay tactic, but the wealthy know that you could put the money into it, and then they get really creative. They know that there's qualified charitable contributions out of these plans. They know that they could convert that plan into a Roth and never pay tax on it when they have a year where they create other loss. And the wealthy know how to avoid tax by doing that, but they understand the power of defined contribution plans, especially in years when they're having really high income. Number 8 is its sister, which is the defined benefit plan. I'm just going to call it a DB plan for short. And what that stands for is defining the benefit that you're going to receive. And the IRS allows us to use something called an actuary to do a projection saying, hey, how much money have I been making? And then based off of what I've been making, how much would I need to put aside in my retirement account so that when I retire, I get that same amount of income? Now they cap it. It's always around a little over $300,000 a year now. But let's just say I'm making 300 grand a year and I have 10 years left before I retire, and now this plan needs to kick out $300,000 a year. I'm going to have to probably put in upwards of $4 million, some really large amount, to meet that requirement. It's for it to pay me the benefit of $300,000 a year. If that's the case, I might be putting aside $400,000 a year tax-free into that defined benefit plan. And if you think that you just misheard that, no, there are clients putting in $600,000, $700,000, $800,000 a year plus. I think the most that I've seen with the actuary that I work with was over $1 million a year somebody was able to fund out of their active ordinary income that was coming from their business. They're literally deferring that income until they're required to take minimum distributions at some point in the future, decades from now. So you see people routinely putting in, I would say the average is probably $250,000 to $350,000 a year using a DB plan. And my guess is a lot of you guys had never heard of it until today. That's because we're so used to doing the defined contribution, because we're used to the $7,000, $7,500. We're not used to the $100,000, $200,000 plus. If that's you, a defined benefit may be in your future because you could put so much money aside. Number 9. Let's see if I could write it out. 121 exclusion, and then I'm going to call it the lazy man 1031. And what this is, really simple. A 121 exclusion is when you sell your house and you have a capital gain exclusion. The wealthy know that they can avoid paying tax, let's say they're married, on $500,000 on their primary residence. They also know that you can combine that exclusion with the 1031 exchange if they need to avoid tax on its entirety. In other words, they realize that if you're selling real estate, if you want to pay tax on it, when you have big gains, it's your choice. You could probably avoid it. So they use that 121. But they also know that there's something called the passive loss rule, and if they can use this depreciation to create extra loss, that they could use that against their capital gains when they exit a position. That's why they call it the lazy man's 1031, because all they're doing is they're creating big passive losses when they're acquiring assets. They do something called a defined benefit bonus, defined benefit, not defined benefit, excuse me, cost segregation, and then their bonus depreciation on that. And it creates these big paper losses that then they could use to offset the gain when they're exiting a position. And that's why we call it the lazy man's, because it's like, hey, I'm just going to go ahead and take that extra depreciation. I'm just going to buy some more property, and I'm going to not pay any tax on mine because it's passive. and is going to avoid paying tax. The rich do it. You should know about that too. Keep it in your toolbox. Number 10, I'm going to write this down here. I'm just going to call them munis. And this sounds really boring. Municipal bonds that are tax-free. So a lot of folks get into the higher brackets, and by the way, I resemble this sometimes. Like, I actually have accounts that are tax-free muni bonds, ETFs, and we're always rotating for things that I know will never, I'll always be able to live off of this money. So it's my non-risk money. The wealthy know that they can create tax-free income and that it's better than taking risk for a higher percentage. And let me explain what that means. Let's say that I'm going to do some private credit, and I'm going to say, hey, I want to target around 9%, but I am paying over 50% in tax. Let's say you're in California or something like that. You're just getting hammered, or New York or New Jersey or one of those states, high income, high state taxes. So they look at it and they go, that 9% I made is really 4.5%, versus maybe I go munis and I'm going to make 4%, 3.5%, or 4.25%. Is making that extra 1% worth the risk? Or am I okay just going into bonds, not paying any tax on it, so it's a smaller amount, but its net effect after tax is such that, hey, this is a better return for me. So the wealthy take a look and they do some bracketology and they look and say, are there things that I can't control? How do I avoid paying tax on certain types of income streams? How can I do that to where it doesn't matter what else I'm making? I know that that return is always going to be tax-free. And that way they don't have to sit there and worry about that. And tax-free munis do it. A lot of people think, oh, they're too conservative for me, or they're not making enough. The market's doing so great. The wealthier you get, the less risk you want to take because you don't want to unretire yourself. If you're already at a point where you don't have to work, it becomes a different game. If you're already at the point where you have enough assets where you're like, hey, I'm not going to outlive this. I'm going to have this money coming in. Then you don't need to go out there and spin the wheel and gamble. You're going to take a bunch of it off and say, hey, I just want to know that this much money comes in and it doesn't matter what else I've done that year. If I'm in a high tax bracket, so what? If I'm in a low tax bracket, so what? I know this money's coming in, I don't have to worry about it. You go that route. The rich do it. You should look at it. In case you're in a high tax bracket, that becomes something that you should look at. Number 11 is something called a donor advised fund, also 501c3s. And there's different flavors. Those 501c3s and charitable organizations, you have public, you have private. A lot of the really wealthy end up going into the private foundation world where they have to give a certain amount. A lot of people don't want to do that. They may set up something that actually is doing something, a public charity, and they know that there's this thing called a donor advised fund where they can park cash in the meantime. They can even fund their public charity so that it stays a public charity. Some of you guys are savvy enough to know that public charities, they use a reverse look back, a 5-year period, and maybe it's going to be reclassified as a private foundation. There's reasons that you might not want that to occur, and the wealthy know that they can use a donor advised fund, which is a glorified brokerage account. That is, I've given the money, it goes into that account, and I can do what I will with it investment-wise. I can trade with it, I can invest in things, in ETFs, I could trade the stock market. And eventually that money is going to go to a qualified 501c3. Depending on where you park it, that could even be your 501c3. For example, Anderson has its own donor advised fund, and you could direct it to a 501c3 in which you sit on the board that you control. So you could put the money in a donor advised fund, trade it, let it grow over the next 10, 20 years. There's actually not a time frame on it right now. Sounds crazy, but you could literally park money, let it grow, 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 and then it goes into the foundation. And I know some of you guys are thinking, but I don't want to give away all my money. You could work for it. You could still pay salaries. You could still have your kids sit on the board. That's why wealthy people set these things up. You almost never see a truly wealthy person that does not have a foundation that they have in their name or that they're working through, because they know that is a great way to do this one. Number 3 works in conjunction with this one really, really well as you're preparing the next generation. Hey, I've made it, I've done really well. I want to make sure that my kids know what it means to give back, maybe my grandkids, but I don't want to just give them something because I don't know what the future holds. What if they have substance abuse issues? What if they have a broken picker and they keep picking the wrong spouses and they get married 6 times? All these things come in. This is a great way to say, hey, you don't own it, but you could work for it. You could sit on the board and you could still direct whatever it might be. And again, charities can be amateur sports, they could be science, they could be education, they could be feeding the homeless, they could be providing shelter, they could be religious, they could be all these different things. Maybe that's something that you want to leave behind, that you want to create. Or it could be, again, private foundation where you're just supporting other charities. But in either case, your family members can continue to work, and then they have to work to get paid, which might be something, I know it's something that a lot of my clients care about, and they're really focused on, and they're like, hey, I don't want to just dump money into somebody's lap. That may be the worst thing for them. It may get them off the path that they're on, that they need to be going down, and change their life trajectory. So they know that there's these donor advised funds. They also know that, hey, maybe this particular year, I want to give away more and offset more of my income. Maybe I make a large cash gift into a donor advised fund before the end of the year, knowing I get a big tax deduction this year, and then I'm going to use that money in future years to give it away. It's called getting lumpy, where maybe I make one huge bequest every 4 or 5 years versus giving money every year that I may not get a big benefit from because of the standard deduction. So maybe they say, hey, instead of just doing, maybe I'm used to giving $5,000 a year, maybe I give $25,000 every 5 years using a donor advised fund, so I get the big $25,000 deduction. If you know how the standard deduction works, this might end up being something that you actually get tax benefit out of, versus if I did the $5,000, I may not exceed my standard deduction. I'm getting no tax benefit. The wealthy know that. You should too. So there we just went over 11 strategies that the rich used to avoid paying taxes. And anybody can apply these. Maybe it's 1 or 2, maybe it's 3, maybe it's all 11, but that's your toolbox, and that's how you can avoid tax. Hey guys, like, subscribe, share this with anybody you want. Till next time.